Okay, well, a volatile week where ironically the VIX get crushed. Now trading down, I think, well under 30. How about that, huh? Market volatility, all driven by headlines and tweets and uncertainty, and a vicious sparring match between China and the US. Stock markets were pretty volatile. Midweek rally on the hopes of easing US China trade tensions, but they kept hitting each other back. Besant and Trump made it seem like negotiations were in progress. China says we haven't even begun to talk, and it went like that all week. And the talks or the rhetoric stopped on Friday. Mixed signals from both sides of the ocean about what's going on with tariff policy. And the major indices still were able to eke out gains for the week, but we're still down 13%. Year to date on the S&P 500. We've got kind of an ironic mix of elevated inflation expectations and weakening economic signals. But luckily, the bond yield has come back down to earth a little bit, around 4.25 now compared to the 4.5 on the 10-year, and we're off the 5-year yield we were seeing on the 30-year Treasury. So the indicators that were released, the economic data, really did suggest that we're heading into a frigid period. The April University of Michigan Consumer Sentiment Index fell sharply. I think it was one of the lowest prints we've seen in half a century. 81, Reagan era, just after the Volcker nightmare. So 6.5% inflation expectations in that survey moving forward. So again, declining economic forecasts like the leading economic index, which was for March, and the IMF recently downgraded global growth, citing tariffs. So tech stocks were a little stronger. We're going to find the pocket of strength in tech. It's definitely not universal. And NASDAQ probably did the best today with companies like Tesla and NVIDIA having some nice weekly advances, Musk leaving Doge and getting back to focusing on his company. That's where the stock price has just gotten hammered. That certainly helped turn things around over at Tesla. And Alphabet / Google on their Gemini advances and earnings have already been impacted by their AI efforts. And I guess the most important of all is the yields and safe haven demand have started to normalize just a little bit, at least in the very short term. I don't think there's anything normal about a treasury bond that used to be the tier one asset, right? Down 50%, the 20-year, or basically the TLT that measures the long-term debt of the U.S. is still down 50% in the last 5 years. The yield on the Treasury note, though, did decline. We're about 4.25, as I mentioned. Gold prices just escalated to the moon. I think we peaked at $3,500 an ounce overnight, and then we've floated back down a little bit. And the dollar's been pretty weak. So that's the backdrop of economic data. Of course, Cheat Sheets is a data service where we, and I'm getting used to this Google Meet application, which I don't think is very high end. My apologies. See if I can move this here. So we follow our data, and there's basically 3 major sets of data plus trading signals that we share with our subscribers, both free and paid throughout the week. One of them is a stack ranking of tailwind scores, sort of our composite proprietary technical rating, but it's fueled by publicly available technical metrics. So it's really easy to follow. We don't try to hide anything. And then we have a little bit more sophisticated relative strength rank and trend report. That's where we combine price performance and money flow and trends and come up with a grading system. So that's more about where the puck is likely to go in the future, whereas the tailwind scores are kind of a measure of where things are today. And then, of course, we use factors from both to occasionally put together quick view charts for us, which are just basically color-coded charts and so instead of splatting a whole bunch of indicators at you, we consolidate a few things. And if we get the indicators that we think are really important to follow when charting, when they light up the chart green, it's good. When it's red, it's bad, at least from a bull-bear perspective. We're a bullish end-of-day data service for trend following traders whose time frame is on a few weeks to a few months. So we're not looking to pick market bottoms or try to identify and get out exactly at the top. And in fact, our trades are generally over when we break through support and trigger a stop loss. So when we fail, the trade is over. We make big money on like 30% of our trades. We might lose, incremental amount of money on, 40% of our trades. And then there's another 30%, I think that's right, 30, 40, 30, that essentially have low single digit gains. And that's kind of the way trend following works. So it's, 3 stocks out of 10 that you pick and decide to ride that really determine your performance. And if you can do better than that, you'll get richer that much faster. The key is controlling losses. And we do that with this color coding system in quick view charts. So probably the one that is the simplest. It's actually sneakily simple, but it's really powerful, is our market sentiment background. It's just green light, good. It's like that Squid Games. Green light, good. Red, you're going to get sprayed with an AK. No, I don't mean that. So light green is bullish, a trend that could last, a few months to up to a year. And a light red is bearish. That means we're likely any rally that we have is going to get stuffed. And so when we're bearish in the long-term sentiment, we are lucky if we're able to eke out a month trend when market conditions are like that. Now, we have some very specific technical metrics. I'm not going to get hung up on those here today. Let me just show you, for example, the SPY. So we can kind of walk through what it means. Now, obviously, you can see where the volume on the SPY, that's the S&P 500 ETF that tracks the major large cap index, which is a market cap weighted vehicle. It means that the big companies like NVIDIA and Google and Microsoft, et cetera, they contribute more to the index. And you can see when we're going through our tariff tantrum a couple of weeks ago, we saw volume spike like we hadn't in years on this index, and prices plummeted. And then we've slowly floated back at much lower volume and not much and declining volatility. So the coding system basically turned red back in February, about mid-February or so, suggesting that the months-long predicted outcome for the markets was not good. And so the red signal is a place for you to sell calls, covered calls, to tighten stops, to perhaps reallocate your portfolio, to take fewer trend trades, to maybe cut risk in half if you're going to initiate something new. It's just a little bit of a bell that says, hey, we think there's trouble ahead. Make sure you're buttoned down. So if you're buy and hold investor, just reallocate your portfolio, which is a choice. That's how you can take action. A lot of us trend followers are just using trading accounts to generate alpha against the market and are in and out in far less than a year and are willing to live with the tax consequences of that. Then we get out of the market when things turn red. Personally, I have old-fashioned investments, stuff I set and forget and reallocate occasionally based on red light, green light signals. But in my trading account, that's my fun money account. So I try to make gains in order to buy things like vacation experiences I could never afford. I'm basically middle to maybe upper middle class before I retired. I had a job that paid decent, but certainly not in the upper end. I'm no Wall Street, K Street lobbyist. At the same time, I'm not struggling. I wasn't struggling, ringing up sales at a grocery store. So I was living an okay life and saved money enough to be able to put it to work to turn a carnival vacation into a Silver Seas vacation. I like cruises. I would never pay more than a carnival vacation, but especially because some of those really high-end cruises can be like 15 grand for 2 people for a week. That's insane. I'd never do that with real money, although I did it with real money, but it was money I made. And the money was really good the last few years because the market just went in one direction and we were able to find stocks that did really well. Things are a lot tougher now. Let me see if I can figure out how to take me off camera. And that way we get more, I think, screen real estate. So I'm going to turn my camera off. I guess not. I guess you still have to see my icon there. but I'll be less distracting. All right, so we have a yellow foreground, red background. The yellow exponential moving average, the 40-day exponential moving average, that is our intermediate time frame. And when price is below it and pointing lower, that is one notch in the bearish camp. We don't like to trend follow unless that price is above 40 and the 40 EMA and that 40 EMA is rolling up. And there are two other indicators that also must be true in order for us to get a green indicator, meaning to get that moving average line to turn green. We want money flow, Chaikin money flow. We sometimes call it buying pressure, depending upon which data table we're looking at. We want that to be bullish, money flow above 0.1, or very bullish, FOMO level bullish above 0.2, even better. And the other thing is we have a series of market forecast oscillators. Imagine if you're able to Benihana the RSI into 4 different time frames, a day trading time frame, a swing trading time frame, and a position trading time frame, and an investing time frame. And you had an RSI for each one of those. Well, we want that that intermediate multi-week to multi-month time frame to be flashing green for us to work. And it'll all make sense here in a minute as we get to the definitions. So a green scenario, green bright green, green dark green, we look at those as bullish continuation or initiation periods, especially with the background. So intermediate and the long-term market forecast line up, and our momentum is bullish or very bullish with money flow, meaning institutions are along for the ride and purchasing. So in a perfect world, a bullish world, and we're hard pressed to find green scenarios right now. Some green yellows, but a lot more red yellows or reds. And that just speaks to the kind of environment we're in right now, which is bearish. And we're going to kind of use these charts and other data to see if we can figure out whether or not this bounce that we're experiencing is, we hit the market bottom and we're going to V right out of it. I'm less convinced that's true. But again, I never trade at what I think is going to happen. I trade based on the preponderance of the evidence in front of me based on the data that we generate. So I do have an opinion, but I try to separate my opinion from the technical setups. And a lot of times that can be really uncomfortable. All right. Here's the NASDAQ. Now the NASDAQ did turtle head above the 40-day EMA. Again, the volume on the bottom of the screen, it's pretty anemic, right? We've got kind of an average of the last 50 days of volume. And you can see starting in mid-February, institutions started bailing out of the market as things were kind of volatile with Doge and some inconsistent policy statements out of different administration officials, almost like they were fighting. And there were concerns about inflation and the Fed. And we just had the rumblings. And of course, it all came to a head in early April with Liberation Day. And then now we've since settled back down. But we floated higher and we have a red yellow situation. So that still means we don't have money flow above 0.1 and the market forecast intermediate oscillator saying bullish or better. Okay, so one of those indicators is off despite price pressing slightly above the 40 period EMA. Now, one thing, this is an end of the day signal, and it may be that if money flow is bullish and the market forecast oscillator is bullish in our data stacks, which we'll see in a minute, this will turn green when we get a new candle. So the color change doesn't happen until you start trading the next day. So with a little bit of a black band there, it's possible that we have met the minimum criteria on Qs. Anyway, slightly more bullish than most of the other indexes here. And again, if you want to get really technical, I'm going to spend just a little bit of time on the bright green 40-day EMA here. We want the close to be greater than the 40-day exponential moving average, and we want that exponential moving average rising. We want, now for a bright green line, this is the foreground moving average line. For it to turn bright green, we do want that FOMO level of CMF or Chaikin money flow. It's just a measure of how much buying pressure there is. And that's a very important metric to my trading. Also, that intermediate oscillator above 50 and rising, or above 80, that would be very bullish, closer to a trend exhaustion above 80, but still very powerful momentum. So that's a bright green. That's the strongest kind of quick view chart we can get. And the worst quick view chart of all is bright red or dark red, red. And that simply means, and this of course are the metrics for the moving average in front of us. That means money flow is either below negative 0.1 or below negative 0.2. It means institutions are dumping, if not puking up stocks. And as a result, the long-term and intermediate-term oscillators, when we're in the case of a red background and foreground, that means that the oscillators are suggesting more bearishness ahead. It's an extrapolation of momentum. And then, of course, price has to be below a descending 40-day exponential moving average. When those things are put together, you kind of get a market condition. So it's kind of the first thing I look for in the morning. I go to my trading platform and I scour the major indexes and the futures like gold and Bitcoin and the 3 major U.S. indexes and a few of the currencies that trade overnight and the Asian and European stock markets to kind of get a sense of where things are at. And that is sort of what I would call the primary pass, and it gives us a color-coded assessment of the way things are. Next are our tailwind rankings, and this is where we spend most of our time in our printed version of cheat sheets. And here, these are all up to date now. These are data stacks where we're comparing different index, sector, subsector, or specialty industry groups or thematic ETF collections together. This is our broadest swath, although it's much more US-centric than not. We plug in one international ETF here, the VEU, in order to compare the US to it. And as you can see, VEU is the only one that's optimally bullish. If you look at our user guide, 60 to 85 is our sweet spot in terms of mixing and matching these 10-factor pre-trade technical elements to come up with this composite score. And so the way the score is broken down is the first 3 metrics on the left-hand side, factors 1, 2, and 3, those are what we call lagging indicators. So these are about moving average position. And we use the 10-period and the 40-period moving average. And in the long-term trend, we're using the weekly time frame, the intermediate trend daily time frame. That is our sweet spot time frame. And then short-term, we're using the 10-hour versus the 40-hour EMA. And when the 10 is below the 40, then that means that we've turned bearish in our trend outlook, and bullish, obviously, if the 10 is above the 40 in one of these time frames. Factor 4 is one of the most important, and even though it is a lagging indicator in that it's looking at the relationship between price at the close of each day and the volume associated with that price. Like a really big up day at really big volume is a really good thing for the money flow calculation, which is another way of saying buying pressure. And the opposite is true when we get intense volume and we're closing at our lows of the day. Then buying pressure is weak, and it's a 20-day average of that information. And so it's a very short-term lagging indicator, but incredibly important because it speaks to our institutions along for the ride and accumulating stock, and if so, at what level. And so we like bullish, especially very bullish buying pressure. And we like it to be persistent. We'd like to see that day after day. The next 2 metrics, factors 5 and 6, those are very important metrics. They are lagging indicators, but what they're doing is looking back at price performance relative to an in-common benchmark. And we're using the Russell 3000, which is the IVV, I think it is. It's IWV or IVV. Anyway, it's one we don't have, it's an ETF we don't actually list here, but everything is compared to that. And therefore, because we're comparing all ETFs to one common US stock market benchmark, we're thus comparing each ETF to one another as well. And so if we're outperforming, that is that the percentage increase in price or even decrease in price is more positive than the underlying index that we're measuring against, that would be positive relative strength. So two prices could be going down, meaning ticker A and ticker B, could both be downtrending. But when you compare those tickers to an underlying benchmark that's also going down, one might be going down more than the benchmark, one might be going down less. And so even though the price is going down, when we're looking at relative strength, it would be a positive relative strength divergence. So in other words, we're outperforming. So we can go down less than another stock and we'd be outperforming it. Now, obviously, you want relative strength metrics to be positive, to diverge positively against whatever you're comparing it to. And in a perfect world, that relative strength would also be happening while price is going up from one period to another. That would be positive relative performance in an uptrend, which is what we're looking for. But we can measure relative strength even when we're bearish, even when most of the trends are down. Like you can see in this stack of US index ETFs, most of the long-term and intermediate-term trends, the moving averages are upside down and price is moving lower. But in a few cases, you're starting to see some at least neutral positive to outright bullish relative strength patterns and buying pressure. And so when we start to see those things, we start to get a feeling like, hey, something might be changing here. We're going down less and we're outperforming that before the price actually starts going up. These can be early warning signs of a turnaround time. So factors 5 look at this last 6 months. So price 6 months ago compared to today, we're comparing all of these against one another. And if we're bullish or very bullish, we're significantly outperforming anything that's not. And we are comparing it obviously to the broad US stock market. So we want to see bullish in the 6-month look back period and the 3-month. Those timeframes constitute what we'd call the sweet spot. So once again, outperformance doesn't necessarily mean positive price performance. It simply means positive relative price performance. So a very important metric for a trend follower. Once something starts outperforming a underlying index or another ETF in the same family that you're comparing it to, that tends to be persistent. So it's a very important way to find the thing that's going to go up the most, that has a better rate of change in a positive direction. And then we have our market forecast oscillators. Again, this is where we're breaking up the RSI into a sliver. Factor 7 is our longest term time frame, months to maybe a year or more, up to about 18 months. If we're bullish or very bullish, then we have a better likelihood than not of seeing higher prices up to a year and a half down the road. Now, there could be several mini trends that ebb and flow within that. But when the market sentiment or long-term forecast, factor 7, is positive, that is a tailwind that's at your back. Now, the other thing is true is it's when it is bearish or very bearish, even if you have shorter time frame metrics that have turned around and you've got a stock that's going up in price nicely, the fact that you have a negative long-term sentiment or forecast, that can just tend to cut the trend short. So typically, an intermediate trend that's healthy with wind at its back can last, a good 12 weeks, a lot of times, 10 to 12 weeks. But when you've got that longer term time frame market sentiment, factor 7, also called the long-term forecast, kind of blowing in at you from off the ocean, it's hard to get the sailboat out to sea and things tend to get cut short. And the intermediate forecast is incredibly important. So when we see that one line up with the long-term market forecast and buying pressure, those three in combination can be one heck of a good leading indicator. So what I think I wanted to point out here, and then of course, we have shorter term timeframes that help us with buying signals, the buy and sell signals with the near term and momentum signals. But the ones that do the heavy lifting are factor 7, 8, along with 4. So when we have been going down, those three and maybe the short time frame relative strength metric are probably the most important things to look at. So right now, VEU, the one thing it doesn't have is tremendous buying pressure. In other words, institutions, even with the more healthy ex-US all-world ETF that basically shuns the NASDAQ and the IWM and all of the US stock indices, even then the buying pressure is just not, it's not intense. So it's a warning flag. And we really would like to see that get better. The other thing is the long-term forecast, of course, is a headwind that's blowing at you. But we do have a bullish intermediate forecast. So this tells me a little bit of, I'm not trading full positions. I'm not going all in on VEU. Even in my investment account, if I'm starting to build back up my international position after getting stopped out, I'd probably do it in thirds or maybe even fourths before getting back there. I want to see these metrics change. And now bonds, if you've been reading my cheat sheets, you know how negative I've felt about bond yields going up. And when bond yields go up, bond prices go down. That is, when you are holding an ETF or a treasury bond or a note, you are essentially giving the government a loan with your precious capital. And when you see buying pressure, bearish or worse, it means your capital is at risk, because while you're buying, other institutions, big money institutions that have the relationships with government, that get access to better data sets, even if you are a cheat sheet subscriber, when they're selling treasury bonds, and especially during a kind of soft pre-recessionary period, that is troubling. And what was very troubling was watching rates go up last week, crossing over 4.5%, because the United States is in a lot of debt, and it has to roll a lot of debt, financed at practically 0% interest 5 years ago. About 9 trillion needs to be refinanced. And it looks like it's going to be prices in the 4.5% if something doesn't happen. And so bearish buying pressure on bonds means higher cost of credit. And the TLT is sort of our catch-all for long-dated US debt. As we eyeball SPY, RSP, which is a version of SPY, it just doesn't allow stocks that have much bigger market caps to count more. So it's called an equal weighted index ETF. That's RSP. And then mid cap stocks and small cap stocks, IWM, Russell 2000, smallest companies out there. Q's, leans toward tech. It tends to be a large cap, the top 100 large cap, mostly tech, but a lot of financial companies too. And then IWC micro cap. These are tiny little publicly traded small businesses. And then Dow is our multinational. And this is the one that's going to get hurt by differences in the dollar. The dollar collapsing at home actually tends to be good for multinational companies that export a lot of stuff, because they're repatriating profits generated overseas in dollar terms. So that is a headwind for earnings. And that's, but unfortunately, trade barriers are going to make it tougher for us to export anything, or let alone import. And import's going to be worse. And so the multinational DIA is the worst performer with a 13 tailwind score. A reminder that any tailwind score below 40 is bearish, particularly below 30, that's very bearish. We have kind of this no man's land or no person's land between 40 and 60. Between 0 and 40%, 50 and 40%, meaning we're on the other side of that 50 percentile breaking point between red and green. We're slightly bearish on stuff. So it's not a disaster, but we're not going to go all in when we've got a tailwind score below 50. Now, between 50 and 60, it means some metrics have turned, and it depends on which ones. If it's buying pressure and the intermediate forecast, and those are both portending good things in the future, I tend to sometimes favor tailwind scores below 60. 60 to 85% is the sweet spot. It's when the most number of backward-looking metrics and forward-leaning metrics are coming together to paint a persistently bullish picture. That tends to be where we're optimal. It's what I populate my watch list for most, and then I'm looking for pullbacks and bounces, or in the context of an uptrend, or if we're not uptrending yet, I'm looking for breakouts, and then I'm trading them. Then we get into the above 85% category. Now that is our most bullish scorecard. It means we're screaming higher, FOMO levels of institutional buying pressure in factor 4. Multiple oscillators can be extrapolated to say things are accelerating. And so it still should be good tomorrow based on the accelerated price performance we're seeing today. So it's kind of that's our forecast. And then we're looking back and we're seeing our trend lines all bullish, and we're seeing our relative price performance bullish. And we know because price is going up, it's not only positive relative strength, it's positive absolute strength as well. So when all of those things are cooking, it's great. The problem is, where do you go from there? And typically once we're above 85, it means the shelf life on a trade is less than it would have been as we move from, for example, 59 to 60. And so once we're up at that level, things tend to, not always, but they tend to peter out at some point. And so generally when I'm looking at things that are that high, usually I'm waiting for an intermediate pullback that might send the tailwind score even back down and below 50 temporarily. Let it, get its horses fed and watered, and then it's off to the races for another intermediate trend within the context of a much larger global uptrend. That's a lot of times what I'll do, but occasionally I might do things like a in the money covered call or a delta neutral strategy for those of you who trade options. This is where we might get involved in double calendars or iron condors or strangles or other sorts of strategies that that can be, tilted in one direction or the other. But the important thing is that there are shorter term plays because you're not married to a trend because you feel like the trend is it's not a feeling. It's the math is saying, where do we go from here? The answer is, I think it's Spinal Tap said when their Black Album arrived and they said, we can't get much more blacker than this. It was a Black Album cover. And one of the guys said, yep, none more blacker, that's for sure. And so that's where we're at here. In our case, would be none more greener. So here's an example of let's look at the tailwind score here. So 41, we're right on the cusp, right? We're no longer screamingly bearish. And it looks like our backward looking indicators are the biggest problem. Our long-term and our intermediate trends for TLT are bearish, as is buying pressure, but we're starting to see relative performance and long-term and even the intermediate forecast slightly bullish. So there is some hope out there that, and remember, when Treasury bills go up, the value of bills go up, that means yields are coming down, and that makes us sleep better at night because the bond market really is the ultimate metric of prosperity. And as you can see, we've hit a higher high. We have two kind of equal low points, sometimes referred to as a double bottom. We appear to have broken out of that double bottom, but unfortunately it didn't hold, right? So we're kind of floating right at that double bottom neckline, and we've moved from in the 40-period exponential moving average, we've moved from bright red, which is our most bearish, that's institutions, puking up shares, negative 0.2 money flow or lower, to red, which is negative 0.1 money flow to lower, to yellow, which means that, price isn't above the moving average line yet, but either the intermediate forecast or money flow have turned non-bearish, right? And so as a result, we might be seeing a turn. Now, of course, there's been a lot of bad economic news, and bad economic news means the economy is slowing. When the economy is slowing, traditionally, the safe haven purchase is long-dated U.S. Treasuries. That was the playbook for the Great Recession in 2007 to 2009. It was the playbook for the dot-com crash in the early 2000s. It was not the play, and I think it was the playbook for COVID as well, 2020. It was not the playbook in our bear market of 2022. And that was our first experience about 4 years ago, where simultaneously the bond and stock market started going down together. And that was scary because most retirement portfolios are based on this 60-40 asset mix, 60% stocks. When they go down, the 40% of your portfolio invested in the safest, quote unquote, risk-free investment, treasury bonds, well, that tends to go up. But that correlation broke down, and we're scared that it's going to break down again here if we head into a bear market. All right. And here's another, kind of a leading. This ETF tends to lead the way down. And we're kind of interested to see if IWM or the Russell 2000 ETF is making any strides to get back into a bullish direction. Now, we've had a nice rally from the low at 170, 173. We closed, a good, better than 10% higher than that low at 194. In fact, we're close to 20% off those lows. And that's encouraging. We did kind of break through a bit of a resistance line at around 185. We're at 194 right now, pressed up against the 40-day exponential moving average, which is very close to being the 200-day, the 50-day moving average. And you can see we're kind of just below a price gap, where I've drawn that red horizontal line. And so that's kind of a key resistance level there. We need to kind of get through all that muck to start trending up. So we're kind of at a very key point right now for the Russell, and we didn't get a whole lot of big volume here. So I would say I'm extremely cautious about that. Now, those were the indexes. I'm going to speed things up a little bit here. And we'll now, instead of explaining all of the technical indicators here, we'll kind of look at where the opportunities might be, or at least where the signs of a turn are coming from, if there is any turn to be had. Well, the bad news is when you look at this, most large cap US sector ETFs are below 40% tailwind score. When you add up the technical metrics, this is telling you that most of the market is expected to go down. If not from here, at some point, this rally will fade and will roll over. Now, are there some green shoots within that majority red configuration? Well, the first place to paint your vision, to point your vision, is the buying pressure statistic. And I would say that we don't see strong buying pressure anywhere. We see enough places getting a neutral plus rating. And a neutral plus rating is Chaikin money flow above 0. It's actually above 0.05. So it's closer to 0.1, closer to bullish than it is closer to neutral, meaning 0 being neutral. And so that's important, that there is at least we know institutions are pretty much, in very few places, except maybe energy stocks, they are not aggressively selling any of these ETFs, any of these sector ETFs. Okay. So it's sort of saying that, I haven't been picked for kickball yet, but there's still a few people left. So I haven't been picked last yet. Okay. And I think that's where we're at here. So buying pressure on XLP, consumer staples, is slightly better than neutral. XLI, industrials, put a pin on industrials. I want to share something with you top down a little later on. That's somewhat bullish. The SPY overall, because it's market cap weighted, is somewhat bullish, and that might be because XLK's buying pressure, neutral plus, is somewhat bullish, and there's an awful lot of XLK's market cap weighted, Teslas, Amazons, et cetera, that are making the SPY the ETF that it is today. Basic materials, even consumer discretionary, XLY, and healthcare all have neutral plus ratings. So that's a pulse. Okay. Now, add to that, there is a pulse for some of the ETFs also showing a pulse with the intermediate forecast, actually more than a pulse, a bit of a racing pulse. And coupled with that, the long-term forecast, meaning, remember, that's that headwind. If you can get that headwind to turn, even though it's blowing ever so slightly, it's not blowing against you in a few places. So if we eyeball factor 4, factor 7, and factor 8, and we can conclude that there's no red splotches in those 3 places, this is where to be vigilant and build your watch list and look for stocks in these ETFs, these sectors of the economy, because that, if there's going to be a recovery, this is where it will come from. Okay. And again, we want to see these numbers strengthen. We want to see bullish buying pressure, frankly, very bullish. Whenever we're in a down market, we want institutions to start buying something hand over fist. that is a definite sign of the non-apocalypse. And then and the market forecast at bullish is just perfect. In fact, that's optimal. So if we can get buying pressure and get the long-term forecast to continue to progress, although neutral plus is fine. Frankly, a neutral plus factor 7, a bullish factor 8, and a very bullish buying pressure would be my idea of puppy dogs and I can't remember what the expression is, but you know what I'm trying to say. Very bullish. Okay. So let's look at XLI here because this one's interesting. We don't yet have, we have a green background. So that is important. It's very hard to find market sentiment that's turned green. And again, this is that neutral plus sort of green, not the FOMO level of green, but we'll take it, right? It's non-bearish. It means that there is a little bit of a breeze at your back and price has closed just barely above that 40-day exponential moving average. We know that the issue here is most likely the buying pressure is not yet above 0.1 because we saw that the intermediate market forecast oscillator has turned bullish. So as soon as we can get into bullish money flow, that 40 period exponential moving average, that daily exponential moving average, when it turns green, that will be a good thing. And obviously the whole policy driving the administration's plunge into tariff land is all about getting America to build more factories and to make more stuff here locally. So if there's going to be investment, you're going to see it come through the XLI. Well, we'll see it come through the bond market, right? But the cost of capital. But XLI is going to be the companies that benefit by reshoring their manufacturing capability or take advantage of their already reshored manufacturing capability. Now, what comes with trade wars and tension is the threat of potentially a trade war turning into a hot kinetic war. And that is definitely an issue for the U.S. Military-industrial complex. It does appear that when you put the combined forces of NATO on the ground in Ukraine against it's not just a single country because we know China, North Korea, Iran, and maybe some other countries are helping out. But it turns out that doesn't look like, well, we certainly didn't win that war. We didn't help Ukraine win that war. Our manufacturing weapons capability is not at the scale we would need to win a major kinetic conflict. Now, in the nuclear age, one hopes that never happens, but the fact is that you've got to produce weapons and capacity in order to be able to deter a kinetic war like that. So I want you to pay attention when we go to sub-industry groups as we continue what I like to call a top-down analysis. Pay attention to the aerospace and defense sector because we might see outperformance there. And I think I have to go back into my Meet tab and tell them that I'm not ready to cancel. Stay in the call, please. Okay. I've been running my mouth for way too long. The last thing I want to do is have to do it again. At least you wouldn't have to listen to it twice. Okay. Moving on. And we're going to give you a lot of this data in this weekend's cheat sheet market review. So here's a stack rank of all of the 21 subsectors. So we've got our 11 sectors of the economy, and then this is if we break those sectors down into specific industry groups, like for example, financials, XLF, can be broken down into insurance and small banks and big banks, and then capital markets, things like investment banks and Charles Schwab and Fidelity. So there's lots of little segments within the financial services sector ETF. Sorry about that. And so what we're seeing here is in industrials, one of the sectors you'll see is XAR, which is aerospace and defense. So this is your Boeing, your Raytheon, your General Dynamics, the companies that build bombs, high-tech military equipment, satellites. All of that's part of the military industrial complex. And as you can see, this is green across the board. A 71% tailwind score, which is optimal. We are uptrending in all three time frames, long, intermediate, and short. The buying pressure could be better, but the fact is that there is at least nibbling going on at the institutional level. Our relative performance on the 3 and 6 month look back basis against just about every other ETF here looks great. And then the long-term extrapolated momentum to make a forecast about months to potentially a year's worth of uptrending. That's at least turn neutral plus, meaning the odds are better than not. And our intermediate forecast is optimally bullish. It means that as long as that long-term forecast stays positive, that we have up to, a 3-month rally ahead of us if all things go well. And that enthusiasm is confirmed by also a very bullish near-term forecast that pierced into what we refer to as the upper reversal zone. Think of it like a momentum oscillator breaking out to the upside. And so that's very positive for upward momentum. And as you can see, we dropped precipitously below optimal very quickly. Matter of fact, there's not one bullish or even neutral plus ETF. There's a few that come close, like healthcare services and innovative tech. I'm skipping treasuries because we've been over that. And innovative tech and XAR probably share many of the same companies, or at least industrial capabilities. And of course, we know that gold and silver have been doing well lately. So metals and mining is at least not disastrously bearish, although 37 is bad. When you look at the forward leading indicators, though, that's actually driving the market forward. We have at least neutral plus buying pressure on metals and mining, XME. We've got long-term market forecast neutral plus and an optimal intermediate forecast. So again, perhaps a sector just starting out, but at least it's not bearish. What is bearish are the weeks to months trends looking back. That's really dragging the score down. All right. And then toward the bottom, because there's a lot of ETFs here, 2 pages worth. I'm going to skip that chart for a second. Down at the bottom is our energy sector. So drill, baby, drill. XES, that's your oil and gas equipment. Those are the services for the drillers, the people that make the drill bits and the pipelines and the things, the accoutrements to those big exploration and production companies. And XOP, those are your Exxons and your Chevrons, the ones that have invested in deep sea exploration or have made deals with dictators overseas to split the profits on land they drill for fossil fuels, natural gas. You can see those are under 10%. So very bearish. Also note the transport sector, which has been a bellwether for recoveries, for the last century. Even in this day and age of more virtual human contact, XTM is still an important metric of vacations and commuting and business travel. And, being able to afford a house in the suburbs and commuting to a job in the city. All of those things come together to form your public transportation, your buses, your airplanes, your vans, your new cars, all in the transport business. Not a good sign that we're under 10, along with major banks, because the major and regional banks are the ones that extend loans. I've heard from a lot of friends who will apply for a mortgage and get approved Monday, and then by Thursday, they've been turned down again. And why? Because people are having trouble getting their arms around what the credit situation is of the United States, because everything is pegged to the 10-year Treasury note. Just about every other debt instrument is pegged to what the government will do. And the government appears to be shaky. And capital appears to be fleeing the United States, meaning foreign capital, people that used to buy our treasuries and buy our NASDAQ. They're not here supporting those efforts anymore. And so those are troubling signs and reasons why this is potentially more likely to be a rally that fades. And there's a more than 50-50 chance, in my opinion, based on the data, not because of what I feel, that another leg down is likely before we get out of this mess. And it could be a significant leg down. Anyway, moving on to macro. So macroeconomics are where we combine different instruments, from currencies to commodity ETFs to stocks and to fixed income and dividend payers, to try to get a sense of where capital is flowing. And you'll see in the macro space, when we get out of the US and especially away from US equities, things look a lot more bullish. Gold, for example, still pegging the needle in the upper end of the spectrum. It kind of hit its high of 3,500 midweek, has been kind of floating downward the last couple of days, probably has some more work to do. We could find ourselves in a bit of a no man's land on gold, no person's land, for potentially weeks to a couple of months as we get a consolidation. Not guaranteed here because there's an awful lot of central bank buying. Somebody's buying a ton of gold, and that buying could resume, and we could revisit a parabolic price structure. But if things trade the way they typically trade, then we should see a consolidation, not unlike what we got shortly after the Trump election, where for a couple of months we sort of took time out and started running in the gold markets again in mid-February. All right. Now, the other thing to note is that dollar has been incredibly weak, and as a result, the relative performance of various currency ETFs. FXE, for example, is the euro, and FXB is the Great Britain sterling or pound. And BWX is international treasury bonds, and FXY is the Japanese yen, which typically, for decades has been valued lower than the dollar on purpose as part of something called the carry trade, which we won't get into, but it's a way for people to borrow yen for zero interest and buy U.S. stocks and make a lot of money. Well, when the Japanese currency relative to the dollar goes up, that can get unwound. But so currencies are the big king of the hill right now. And that's just in dollar terms. It's because the dollar has declined about 20% over the last 2 weeks based on the tariff moves that are going on, the reshaping of the global economy. Now, the other ETF to pay attention to is IBIT, green across the board. I am very bullish on Bitcoin, and you can see buying pressure here along with gold is bullish or better. Gold is very bullish. Bitcoin, IBIT is next at bullish. There's nothing else ranking in those levels here. And then you've got neutral plus relative strength performance. You've got the long-term forecast, no longer a headwind. You've got a very bullish intermediate forecast, which means that we might be near the most recent run's exhaustion. We might get a little bit of a pullback or a pause here, but based on these numbers, we'd expect a few more intermediate runs if we do pull back down into the the 40-day moving average. So pay attention to IBIT, Vcash. That's where you hide out and buy short-term corporate debt, and there's SHI, which is short-term government debt. Those are bullish, but again, most of that buying pressure when it comes to bonds and debt is just not there. In fact, you can kind of follow the bouncing bearish ball in buying pressure, and you'll see IEF, the 7 to 10 year treasury bond, bearish buying pressure, SHY, 1 to 3 year treasury. Of course, I've told you about TLT. It just doesn't look good for US debt here. Or the almighty dollar, which didn't even make it into the screenshot, UUP, which is further down the list. Than we screen grabbed, is looking awful. Here's Bitcoin. Now, from a technical standpoint, we have our green scenario. It turned green a few days ago. I gave everyone a heads up. I think it was on Monday's cheat sheet blog. But there, for those that trade technical patterns, there's something I've been watching called a descending wedge. That's a bullish pattern when you have this kind of set of tongs that narrow over time and then price squeezes out and continues in the upward direction. There's a few different ways you can measure price targets. I actually had a price target ultimately of around $120,000-ish on Bitcoin when it was down here near 45, and it was based on a Fibonacci extension, which I've since gotten a little bit more conservative about. Oops, sorry about that. So I originally had drawn from the low to this high, and then the pullback, the indicator will plot some preliminary price targets and full price targets based on what's called a measured move. I shortened that here. So I took this as the low, brought it up to the high, and then pulled it back here in order to generate 2 extensions. I actually kind of like my very first much longer Fibonacci extension first, because this initial price target actually matched up with the high perfectly. And then, this yellow line, the 100% measured move was closer to was over 100. But we'll live with this conservative price target. So assuming I'm right, we should make it to about this resistance level. We're pretty close right now. We might churn sideways for a while, but I fully expect us to keep running to make it at least up to our old highs in the the old highs for Bitcoin's ETF IBIT, right? This is different than than tracking the price of Bitcoin. But we should make it to that 63, 64 level. We'll probably pause again, but ultimately I think we'll get up here near 70 on this ETF. We're currently trading at 54, so definitely another 30% potential here. Now we've gone parabolic here. I would expect there'll be some kind of, but who knows, right? We could just keep exploding until we hit that blue price target. But a green situation because money flow, the price relative to an increasing 40-day moving average and the intermediate market forecast oscillator all pointed north. That gives us the green line here and the green background, which turned first. It means the market sentiment oscillator or market forecast factor 7 turned at least neutral. No, I'm sorry. I think it needs to turn bullish. Maybe not. I think it's bullish. So I think it needs to get a bullish reading or better in order for this to get green. All right. Either way, it's not bearish. All right. And gold, of course, sorry about that. We've talked about here, we hit our head overnight in the futures and got up to 3,500 an ounce. This again is an ETF, so it's going to show things differently. We pulled down at pretty light volume the last couple of days. Huge selling the first 2 days. It's institutions that just recognize that this thing went parabolic, and institutions are very disciplined, meaning the so-called smart money never FOMO chases. All right. And so I actually sold about a third of my gold that I've been accumulating. I'm doing it in $200 and $300 increments. I'm using actually a different ETF called Phys, PHYS. And I'm just, every three times a week, I'm buying about $200 of an ETF that holds physical gold. Now I've been doing it for a long time. So I built quite a position there. And just because we were so parabolic, I just snipped it by a third, but I'm continuing to build. All right. So I would expect maybe a revisit on this ETF down below 300 to 290. That's not correlating with the price of gold, mind you. That's just where this ETF's price is. And you can see we've gone from bright green to regular green, suggesting money flow has just waned a little bit. And there's some big volume at the top here. So you do take that seriously. Okay. So finally, I just wanted to share this with you, and I should have put Bitcoin in here because ultimately Bitcoin and the whole blockchain technology is, in fact, the most disruptive tech of all. I'll fix that here because I don't think I have even a Bitcoin equity related ETF, although I've got, or I should say a crypto related ETF. I know I've got FINX here, which is fintech. That uses the blockchain, but I should have had IBTC or IBC. I think there's an equity tracking ETF here. I'll fix that the next time. Needless to say, that crypto-oriented equity ETF would be probably blowing all of these out of the water, okay? So, and what's interesting is ICLN, which is clean energy infrastructure. That is our only optimally bullish one. And you might have heard, that the tariff war is going to keep things like photovoltaic chips from coming in from China to fuel production capacity for the places where we can take advantage of solar and wind to a lesser extent, like, for example, down in the U.S. Southeast, where I live here in Texas. Perfect opportunity for solar. That's probably going to slow down. Just remember that clean energy goes in a lot of places. This isn't just about alternative energy. It probably has much to do with the way we're going to power the energy needs moving forward, because we have fossil fuels is probably not going to cut it. Even though we're drilling, we're building these humongous data centers with power hungry chips. Our need for electric grid infrastructure is overwhelming, especially if we're going to reindustrialize. We have plenty of fuel just not a whole lot of distribution capability for what could be a tripling of demand in less than 5 years based on the industrial needs. Look at Germany as a really good example of what I'm talking about. Obviously, with the Ukraine war, Germany had built a humongous reliance on Russia for natural gas, to the point where they're shipping natural gas via 2 buried pipelines under the ocean that Germany's had paid for. And when they, some would argue, shot themselves in the foot, but when they had to make the tough decision to detether from Russia, the entire German industrial plant was suddenly at risk, because it was, those auto manufacturing plants are hungry for power. They've had to switch to coal and lignite, which is very much against the German ethos of not polluting their skies and lands. And that's been a big problem. And the United States, because of its decision to detether suddenly from China and to cut those workaround routes, the backdoor routes like through Thailand and Vietnam, that's going to make it tougher for us to meet all of our energy needs. So there will be things like nuclear in here, the uranium dependent. So drill down into ICLN to look for specific opportunities there, because one size does not fit all. But as you can see, a little bit of cybersecurity bullishness, especially in the leading indicators, space. And of course, that is the next battleground. And so I'd look at space the way we look at aerospace. It's all kind of part of it. And that is bullish, as is drones and quantum computing. It's not bullish now, but it's just on the more bullish side of the spectrum, at least on the relative basis. So we're tracking that. And this is Bitcoin, which I showed you. All right, that was pretty long-winded, but I wanted to give you this deep dive disguised as a market review so you can get more comfortable with the data stacks that we'll be sharing over the weekend. Okay, so it's video only tonight, but I'll be preparing my typical weekend review, and we'll add some relative strength, rank, and trend reports. I'd love to have you as a free or even paid subscriber. Free subscribers get a lot of benefits, data stacks, the ETFs mostly. Paid subscribers even more. We get down to the stock level. We'll share buy and sell signals. We'll give you some ETF analysis that we don't give away for free. And I would say the paid membership, because we've luckily, thank goodness, have attracted a fairly healthy subscriber base now. More benefits ahead for the paid membership, and I haven't raised my prices at all. I do a lot of work on this. And so if you've got $5 a month, $50 a year, it's just very encouraging to me when somebody recognizes the work to the point where they're willing to write a small check. There is a pride that goes with, I can't believe that someone who's not me is willing to pay me for a small portion of my mind. And so it's flattering. And I really appreciate the a couple of hundred of you that are throwing me the $5 a month. It helps. I retired from the radio industry, had to teach myself how to trade because the radio has been dying for 20 years. And so, fortunately I was successful in that business at its peak and, practiced good fiscal discipline and saved enough money to be able to at least live, put a roof over my head and have some food on the table and occasionally go on a trip or to a restaurant. So I'm, middle to upper middle class. I'd say probably closer to middle class. And so every $5 helps me. And I appreciate it if you are subscribed. Okay, enough of that. Blah, blah, blah. Go to stockcheatsheets.substack.com, and I'll look forward to seeing you in the next video and in our next update. Bye for now, as I struggle to figure out how to stop this meeting.